Hey guys, welcome back. So, in this particular video, we are going to talk about different type of mutual fund. So, in our previous video, we generally talk about what is mutual funds and what are the terms associated with mutual funds like asset management company or the net asset value and all. Okay. So here in this particular video, we are going to talk about the different types like the open-ended mutual fund, close-ended mutual funds, equity, debt and hybrid mutual funds, index funds, sectorial funds, market cap mutual funds, or the systematic investment plan and all. Okay. So to understand these particular one, I hope you already watched the previous one. So if you not, please do watch the previous video. So you'll get an idea about the mutual fund. So in our previous video, we generally talk about the mutual funds. It is a collection of funds which is made by AMCs, asset management companies. AMC, though these are the companies, these are the fund management companies, those who generally manage fund on the behalf of investors. They collect funds, they do market analysis and research, and they allocate that particular fund in these securities. Okay, and there are some fund managers, so it is a working profiles, those who work with AMCs, and they allocate or they invest money in the different securities, and they get whatever return they get, so it is distributed among shareholders. Okay, so we already covered this particular chart, like there are number of investors. From these particular investor, AMC, they generally collect this particular money, and they have fund managers. The fund managers, they generally invest that particular money in securities, and whatever the outcome return, so that is distributed among the shareholders. So you can watch the previous video, so you will get more clarity about the mutual fund. Along with this, you will find out the how to calculate NAV and all. Okay, now in this particular video, we are going to talk about the different type of mutual fund, right? So like we have on the basis of plan, we have open-ended, close-ended, and interval. We on the basis of scheme, we have equity, debt and hybrid funds. On the basis of market capitalization, so we have three type of market capitalization, like small cap, mid cap, large cap. The next one is sectorial funds. So we have different sectors like banking, automobile, hospitality. So when investor or that fund manager invest money in sectors, different sectors, so that is sectorial funds. Index fund, we have different indices as well, like Nifty, Bank Nifty and all. So that is your index fund. Okay, so we will start with open-ended mutual fund. So what are open-ended mutual fund? Whenever you invest in mutual funds, and if you'll go through the mutual fund documents, you'll find two type of mutual fund. One is open. Here it is mentioned open or close or interval. Okay. So open-ended mutual funds are those mutual funds where you can invest anytime, and even you can liquidate these particular fund anytime throughout the year. Okay, so these funds do not limit when or how many unit can be purchased. Okay, so these are market traded funds. You can invest anytime and you can withdraw your money anytime from these kind of mutual funds. Okay, so they are highly liquid in the nature, we can say. So investor can enter or exit throughout the year at the current net asset value or that NAV. So what, let's say you buy a mutual funds, at the time of your buying, the NAV, net asset value, was 10 rupees. Okay, so after some time it become 15 rupees, so you can sell it, or even let's say after some time it becomes 7 rupees, again you can sell it. Okay, so that is totally depend on the investor sentiment. Open-ended funds are ideal for investors seeking liquidity. Let's say these type of funds are beneficial for those investors who basically need money at those who require that particular, this is of, we can say they are more liquid in nature. So let's say you invested in this particular mutual fund at the rate of 10 rupees. After some time you got some emergency, financial emergency, you know you need particular money. Okay, you need money for your child education, for let's say if you are making some other decision, purchasing house and all, so you can easily liquidate these kind of mutual funds. So open-ended, close-ended are just reverse to open-ended mutual fund. Okay, so close-ended funds have a predetermined unit capital amount, and let's say the there is a ABC mutual fund is announced by any XYZ mutual fund company, and they said their fund size is 500 crore rupees. So this is fixed, okay, and also allow purchase only a specific period, which is called NFO, new fund offer. So during NFO, you can buy these kind of mutual funds only during the listing of that particular mutual fund, and listing of mutual fund is generally known as NFO, new fund offer. Okay, so the fund size is 500 crore rupees, and the per unit cost or the face value is suppose that 100 rupees. So there are 5 crore shares or 5 crores unit of this particular mutual funds are available in the market, and you can invest in these particular one at the time of NFO or at the time of introduction or listing of that particular mutual fund. Okay, and even the maturity period is also fixed in this particular one. So let's say the lock-in is 5 years, so you cannot liquidate these type of mutual funds before 5 years. Okay, here redemption is liquidation or the selling of mutual fund is bound by the maturity date, as I earlier told you. So let's say if it is 3 years, so you cannot sell these type of mutual fund before 3 years. However, to facilitate liquidity scheme trade on the stock exchange. So basically, fund manager, they are generally investing that particular money, and the valuation will increase or decrease as per the market conditions, but we have a fixed lock-in period as well as the fixed fund size. Interval is basically combination of open-ended and close-ended, and interval mutual fund permit transactions at a specific period. Okay, so the window for buying and selling in these kind of mutual fund open for a specific period. Okay, so which is basically managed by fund management company or as well as exchange. Okay, so in at the time of this permit transactions time, so you can or investor can choose to purchase or redeem their unit when a trading window is open. So that, like in case of open, it is traded throughout the year. Close, so they have a certain maturity period, but in case of interval, so there is a special window, that is trading window for these particular mutual fund. Investor can buy or redeem these kind of mutual fund only during the this trading period. Okay, next one we have equity mutual fund. So equity mutual funds are those funds where investor or fund manager invest the entire money in the equities. Equities means shares or shares of companies. Okay, let's say there is a XYZ mutual fund, and the asset size for this XYZ mutual fund or the asset collection is suppose that 100 crore rupees. So here the entire money, this 10 crore rupees, so here the entire 10 crore rupees will be invested in equities, or you can say invested in shares only. Okay, so fund manager is investing entire money in the shares. So equity funds invest in company shares, and their return depend on how stock market perform. So these are risky in nature. The growth is like, these are growth oriented funds. Okay, so because equity investment, if you see the equity investment, so there is a high potential growth, and even you can say highly risky. If there is a high growth, there is a high risk involved in these kind of in mutual fund investment. Okay, though these funds can give high return, they are also considered as a risky investment, because we are investing in equities, or the fund manager is investing the entire money into the company shares, and shares performance is totally depend on the market conditions. If the favor, like let's say this fund manager invested the 10 crore rupees in 5 company shares, and out of this 5, average for 4 companies the market was favorable, so the value of your mutual fund will go high or increase as compared to debt funds, or vice versa. If the out of 5, for the 4 companies the market condition was adverse, so the fund value will come down. Okay, debt funds are basically when the fund manager is making the entire investment in debt funds or government securities. So if he is making investment in debt, which means in debt we have fixed rate of interest, so here you'll get the fixed rate of interest and the risk is minimal. Okay, so again this is very simple. Hybrid funds, so hybrid basically these are actually used in the market. So hybrid is basically a combination of equity and debt. So where basically the fund manager, they are using different ratios, or like they can use 60s to 40 ratio. So 60s to 40 ratio means out of 10 crore rupees he is investing 6 crore rupees in the equities, and 4 crore rupees in the debt funds. Okay, so here like we have different set of ratios. It can be 50-50. It like if hybrid fund is growth oriented, so they'll go for this ratio. If it is like minimal risk oriented, so they'll go for the opposite one, 60% in debt and 40% in your equity investment. Okay, so the ratio of investment can be fixed or varied depending on the fund houses. So that is totally decided, and this kind of decision is generally made by the fund manager only. Okay, so hybrid is a combination of equity and debt, where fund manager is making some combinations of equity and debt, and they are making, they are further investing that particular money in the same ratio as well. Okay, now there is a term that is called SIP. I hope you guys are aware about this particular one. So this is like very famous term. Okay, so SIP is a investment type in mutual funds. Okay, so let's say if you want to invest in mutual funds, so you can made a lump sum investment, or you can made a SIP. Okay, so you can choose SIP as well. So this is similar to your fixed deposit investment, as the another one is RD. So in case of fixed deposit, you generally invest a lump sum money. Let's say you invested 5 lakh rupees at the rate of 5% per annum for 10 years. Okay, in case of FD. In case of recurring deposit, RD, you make a investment. You let's say you invest you make investment on recurring basis. Every month you are investing 5,000 rupees per month. Okay, you are investing 5,000 rupees per month for 5 years. So similarly in mutual funds, you can invest one time as well. Let's say you have 5 lakh rupees, so you can invest this 5 lakh rupees in any XYZ mutual fund company. Another thing is, let's say you got, like, you recently placed in some company, you want to invest for 5 years, 10 years, but you do not have 5 lakh rupees or 5 crore rupees in your bank account. So you can start with 5,000 rupees or 1,000 rupees or 500 rupees, whatever your pocket is allowed. Okay, so SIP are basically systematic investment, where investors are making their investment in a systematic way. Every month they are investing some sum of money in some specified mutual funds and all. Okay, so SIP allow an investor to invest a fixed amount of money at a predetermined at a predefined interval. It can be monthly, it can be quarterly, it can be half yearly as well as your yearly, in a selected mutual fund. Okay, so you find this XYG mutual fund. Let's say you did some analysis in the market and you find this mutual fund, the growth of this particular mutual funds, or you find some potential in this particular mutual fund. You do not have 5 crore rupees or 5 lakh rupees in your pocket, so you cannot make the lump sum investment. So you start investing 2,000 rupees per month in this particular mutual fund for a certain time duration. Okay, so how you will get benefit from this one? So let's say you invested 2,000 rupees, and at that time the NAV was 10 rupees. After next month you invested 10,000 rupees, 2,000 rupees, the NAV become 11 rupees. Then you invested 2,000 rupees, the NAV become 9 rupees. Again you invested 2,000 rupees, NAV becomes, suppose that, 15 rupees. You invested 2,000 rupees, NAV become 20 rupees. So now the total investment made by you, or the total number of unit, let's say you the total unit you own, that is 100, suppose that, or 1,000, and the average buying is, suppose that your average buying for this one is, suppose that your average buying was, suppose that in this particular case is 12 rupees, and the market price is, suppose that the market price is, the market price or the current NAV, the current NAV for this particular mutual fund after 2 years, the current NAV is, suppose that 20 rupees. So you'll make a profit of 8 rupees per share. So your profit will be 8 rupees per unit in this particular case. So SIPs are one of the most preferable investment tools in the market, especially if you talk about the Indian market. Okay, so these are systematic investment made by investors in mutual fund, that is called SIP. Hope this is clear. So guys, in this particular video we generally talk about the different type of mutual funds. Okay, hope these all are clear. Still, if you have any query, you can mention in comment section. So these are very important for your examination viewpoint as well as for your investment prospect. So you can go through these particular one, and if you find any difficulty, you can mention in comment section. And if you are new to my channel, please do subscribe. So this is it for this particular one. I'll come with more videos, so stay tuned. Thank you.